Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. A correction on the stock exchanges has turned the magnificent 7 into the terrific 2. He comments on gold, crude, the U.S. and Canadian dollars, and what uranium has in common with orange juice and cocoa. Author of The Money Bubble, John Rubino, says the Fed could be on its way to breaking stuff with higher interest rates. He talks about gold, Bitcoin, and the geopolitical conflicts that could push us into World War III. Publisher of WolfStreet.com, Wolf Richter, weighs in on U.S. Treasury Bills, rampant U.S. consumer spending, and whether this is a good time to buy a vehicle. Plus, at the end of the show, we'll have a company showcase update from RecycLiCo CEO Zarko Meseldzija. We'll talk to Ross Clark right after this.
RecycLiCo, making lithium-ion last forever. RecycLiCo's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. RecycLiCo Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMY.ZF, and Frankfurt ID4. For more information, visit RecycLiCo.com or phone us at 778-574-4444. RecycLiCo, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to the show.
Always a pleasure, Jim.
Ross, how would you describe the stock markets this week?
I would say heavy. That would be probably the best way to talk about this one. We've got, I think we had one update during the week on the broad indices, and that was it. We've been going down since peaking on the 17th, and it's been pretty much a downward motion on the week this week. The S&P, NASDAQ, both down about 2.5%, and it's we're in the heart of earnings season. You're getting a few surprises on the upside, but more than that, the surprises on the downside have been pretty big, and they are weighing on things. The stocks that had been leading the way, the Magnificent Seven, if you look at that, 2 of them are holding up, 5 of them are now in trouble. And so as you look at the index, it's a big rolling top here. We've now broken below support lines. We're below the 200-day or the 50-day moving average on these things. So if the leadership group that had been there into the spring has done its rollover, there are very, very few items that are managing to hold up here. So easiest path has been down, as we would have expected from sort of August into October. Key now is can we break hard enough here to put in a real capitulation low and get a decent bounce. As of now, the oversold that we had at the beginning of October, we got a bounce. We got back to the 20-week moving average as far as the S&P was concerned. That was a target up around 4,400. And from the fact that it only recovered just half of the loss off the high, implied that we would take out that early October low and then try and find a bottom after that. So here we are, down just above 4,100 as of the close of the week, and we would need to actually see the S&P back, I would say, above 4,270 to indicate that that there's been a momentum reversal to the upside. Otherwise, we just look for a hard oversold, and that at the rate that we were declining this week, it actually could be possible by the time we're talking a week from now.
What's going on with gold?
Gold got overbought here on that initial run off of the war with Israel and Hamas, and then had paused for about 5 days. The action, though, holding just the bulk of the gains, and so at the end of this week, literally that last hour of trading, the gold and silver markets came to life. Gold closed above 2,000. Hasn't done that in months, and so we're starting to see a pretty good move there. We'll see what happens around the old highs, around the 2080 level. But at this point, that trend continues up. And I've been thinking, looking at this pattern that we've had in the year where it started well, tested highs in the spring, made that low and then came back. This whole style of consolidation and deep correction, I've got a dozen examples like this. The key now is that we should not give back more than 38% of the run that we've seen off the bottom. So in terms of the futures market, you're looking at something around the 1940 level as probably the worst case that you could accept within a rising trend. If it were to make a 38% correction, I'd look at being a really strong buyer for at least a rally after that. But for now, trend is up, had a pause. It seems to have life again.
What's happening with crude?
Crude had a pretty good week just at the end to close things off. Rallied similar to gold, but it's stuck in a trading range. We've got so we're 80. I was counting 82 days now since we got the buy signal when the market came up off its lows and the crossed above the 20-week average, and the RSI was breaking out. That time frame is the point at which this consolidation that we've been in since hitting the $95 high and pulling back to 82. That time frame matches what we have seen coming out of similar lows in the last few decades. And so at this point, we're at a make or break point. The $82 support level, you want to really keep a close eye on that. That's a 38% correction from the low that we put in back in April, May, and it's been a nice kiss on the 20-week moving average. And of the previous bottoms, that becomes the critical support from which you want to see the next rally. So, trend is up, but consolidating. You don't want to be risking very much. If it breaks through that $82 support, next level of significance would be down around $75 to $76. So, treat it as a market that has got some upside bias, but you don't want to risk too much.
What's going on with the U.S. and Canadian dollars?
U.S. dollar, a quiet week, and considering that all that's been going on, you might have thought with things continuing to stay as bad as they are down with the Israeli and Hamas situation, the dollar index was up on the week about 60 basis points, but nothing dramatic. The important part here, though, is that it had rallied right into the end of September when it got up around 107 and consolidated right up until 2 days ago, at which point we came back and, we look at long-term moving averages for support and resistance. And in this case, the 50-day moving average on the dollar index was kissed during the trading on Wednesday. And we got some nice RSI readings down in the mid-50s. And so this being an uptrend as we've had since the middle of the summer, this is just a nice mild correction to have had, and it looks as though we're just in a place for it to have its next leg to the upside. Hard to say how far, but this consolidation was 107 down to 105. So you had 2 points on the 107. Maybe we're looking at something in that 109 to 110 level as a reasonable target for the dollar index. The other side of the coin, the Canadian dollar, is just continuing to do poorly. Ended up down 35 basis points on the week, closing just over 72. So this takes out all the supports all the way back through the low that we had in March, and it's back and testing the lows that we had a year ago. Problem here is that we've had decent commodities, we've had decent price in terms of the oil market, and the Canadian dollar is just not participating with what should be some great assistance from that side. So when you look at this over, the decades, the key level here at this 72 has really been significant. The years in which we cracked it, which would be back in 2020 when we had the pandemic, also in 2015, 2016, you go back to the pre-commodity run back in the 2002, 2003 range, the supports were all down at 68 or under. So here we are just breaking 72. Looks as though we've got enough here in terms of overhead to push us another 4 cents. So anybody traveling south for the holidays out of Canada, I don't know where you're going to go because between U.S. and Mexico and even Europe, it's pretty expensive.
Anything going on in our so-called anything else file?
Well, the anything else would be, what's going up? And the answer's there. You've got uranium. That's up at a new multi-year high right now. Still well shy of what happened on the pre-Fukushima disaster. But the good action there, the stocks are not participating quite as well. They've recovered about 2/3 of the loss that they had during the last minor correction of the last couple of weeks. But the spot uranium price is going up. Orange juice is putting on major highs. This has gone from $1 to $4. Cocoa, there's another one which has just had a significant move and is sitting at multi-year highs. So, and if you got something that is you're looking for some sweets, now is probably, if you can find something that's still on sale, it's probably a good buy. And the orange juice market, well, I used to like vodka with my orange juice. Maybe I'll just have the straight vodka now. Mm-hmm.
Well, my favorite energy drink now: uranium, orange juice, and cocoa.
You can get a high from that.
Well, talk about a glow in the dark. Russ, thank you so much for chatting with us.
You're welcome, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on X at Charts by Ross. Coming up, John Rubino next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is John Rubino, author of several books on the economy, including The Money Bubble. He founded the website DollarCollapse.com. He's speaking to us from near Port Angeles in Washington State. Welcome back to This Week in Money.
Hey, Jim. Good to talk to you again.
John, interest rates are up, stocks are down. Is this what they mean by the Fed breaking stuff?
It could well be, yeah, because last week, the 10-year Treasury note yield in the U.S. Hit 5%, it's a big round number. It's psychologically important, and it seemed to have an impact. Stocks have been tanking ever since. And the interest rate on the 10-year Treasury has gone down a little bit, but it's stayed up there. So basically, I wouldn't go out on a limb and say, yes, everything is broken now because interest rates got too high. But I will say that when that time comes, when interest rates break the economy, starting with the financial markets, this is what the early stage will look like. This will be the first week of it, when NASDAQ stocks just tank, and the S&P 500 now is in correction territory, which means it's down 10% from its recent high. So there's a long way to go, and it may not come imminently and sequentially, but we're getting there. Things are going to start to break pretty soon if they aren't already.
Debt seems to be out of control in the U.S. Is this the blow-off stage of the credit super cycle?
I think we'll look back on it and say that this was it, because we were already taking on steadily higher debt prior to the pandemic. And then during the pandemic, it just went parabolic. We just started borrowing like crazy and creating, I think we increased the money supply in the U.S. by 40 to 60%, depending on the monetary measure that you use. And you would think that we would, our debt creation would go back down now that the pandemic is over, but it's not. I think the deficit for the most recently completed fiscal year was like $1.65 trillion or something like that. That is a crisis level government deficit. And so we're taking on massive amounts of new debt. And as interest rates go up, our interest costs go up, which means we have to borrow even more to cover our interest expense. We're at $1 trillion a year in just interest expense. And the military budget is soaring as we fight all these wars all over the world, which all have to be borrowed too. So yeah, I think we will look back on this as the point at which the debt orgy went parabolic and eventually completely destroyed the financial markets. So, Jim, we're living through history. Isn't this exciting?
Oh, well, one of my theories is people clamoring for cruises, taking exotic vacations right now is perhaps there's fear of another pandemic-type lockdown. So let's get out and socialize and see things while we still can.
I don't know if that is a very logical approach if you're thinking about going on a cruise, right? Because if there's another lockdown, you're stuck on that boat for however many weeks or months it takes for the pandemic to wind down. So that it seems like the biggest casualty of the pandemic should have been cruise lines, because you're basically a prisoner. You can't hear a news report about some illness in Seattle and then just jump off the boat. You gotta sail back slowly and ponderously.
Well, maybe some people like that idea.
One person on your cruise ship gets sick. But, it could be that some people look at it as extra free time on a cruise ship if they get locked down. But I don't know. I wouldn't think of it that way.
Yeah.
I think of it as like being on a plague ship.
Yes, a gilded cage. And of course, there's still Norwalk as well, because when I went on an Alaskan cruise, I actually booked 4 extra days of holidays for after the cruise because I was pretty sure I would get Norwalk, and I did. Sister-in-law worked on cruise ships for 20 years. She said the secret is don't touch the handrails, don't take the elevators. I don't know. Maybe that's the secret. She never got sick.
I don't think that. Yeah, I don't know though. It's such close quarters. The 2 cruises I've been on were like really crowded hotels.
Oh.
So you're surrounded by people all the time. I mean, if there's a bug, everybody's at risk.
Yeah, that's why you should get a balcony. At least if you're confined to quarters, you still have a view. Gold's up in the past month. Is it due to macro geopolitical events or is it normal seasonality?
Well, it's funny about gold. I've been watching, obviously I've been a gold bug for a really long time. I've been watching the whole seasonality thing basically forever. And every single year, we move into the seasonal up or the seasonal down part. And I look around and I think, macro trends are just so big. They're going to swamp seasonality, so I'm going to ignore seasonality. And year after year, seasonality turns out to be valid, and I turn out to have missed the trade that I could have done just based on seasonality. So this year, right now, we're heading into the strong time when Asian demand for gold from jewelers who are making jewelry for spring weddings in China and India and other places nearby do their buying, which pushes up demand for gold and for silver and tends to raise the price. So through January or February, gold prices normally stay strong. And boy, we're seeing that, aren't we? Gold got smacked during the sell in May and go away seasonal part of the process. And now it's back up again. Just 13 minutes ago in the U.S., gold closed at above $2,000 in U.S. dollars, which is a really nice run from the 18 or so hundred where it bottomed just lately, and is just one or two good days away from the all-time high in this currency. So gold is actually doing very well, and I don't know what to attribute it to because of that whole seasonality story I just told you, but there are a lot of macro reasons for precious metals to be interesting right now. One of them is global thermonuclear war. You know, we're picking a gigantic war out there. The U.S. just bombed Syria, was it? I think it was Iranian forces in Syria. That's the latest news. And Israel is going into Gaza and just slaughtering everybody they see. And the U.S. has two carrier groups in the Mediterranean right now. And so we're right there on the edge of basically the end of human civilization. You know, one stupid move in a world with lots of stupid people with the power to make that stupid move, and it can happen. So, you know, a logical response to that would be to buy a bunch of gold and silver on the assumption that even if it doesn't come to a nuclear war, all these proxy wars and everything we're fighting are at a minimum going to force the U.S. government to spend a ton of extra money, which they have to borrow, which, you know, we already kind of went through the whole debt thing here. And that just adds to the pressure on inflation and interest rates and the dollar's exchange rate and the dollar's purchasing power. And in a situation like that, precious metals make sense. So, you know, it could be a combination that seasonality is strong and the macro factors that normally affect demand for precious metals are screaming buy right now. So it wouldn't be a surprise because we're early in the seasonal part of this, and I don't think we're anywhere near done with the whole geopolitical thing. So this could be a process that has legs where the next few months are pretty good for gold and silver.
Is Bitcoin rising for the same reasons?
Well, it is interesting that Bitcoin just had a big spike up. At the same time, gold and silver were recovering. In Bitcoin's case, there is one other factor, and that is that there's a Bitcoin ETF that's coming to market pretty soon, which means normies, like the 99% of the population that really doesn't know how to buy Bitcoin or any other crypto, will be able just to go buy a stock, which is a Bitcoin ETF, which gives you exposure to Bitcoin. So it could be that people are buying Bitcoin right now in anticipation of that ETF happening. And we know from the past with other physical ETFs, like the Uranium ETF and the silver and gold ETFs, those things are kind of self-fulfilling prophecies. People send them money, they go out and buy the asset and then put it in a vault, take it off the market, which makes the price of it go up, which gets people more excited about an ETF that owns that stuff. So they send more money to the ETF and so on. And it pushes the price of the underlying commodity up above what it would be normally. Could be the same thing with Bitcoin right now. You know, you get some buying at the margin from people who weren't in the market previously, and that makes it go up, which puts it on the front page of the newspaper, blah, blah, blah. You know, so we could be seeing a cycle, a positive feedback loop like that for Bitcoin, which could justify a lot of the buying recently.
Now, in Gaza, they've turned off telephone and internet service now, and I'm wondering if we go to cryptocurrencies and people trading Bitcoin, could the government, if they decide this is too much for them because they don't have a finger of control on it, just turn off the internet. There goes your access to your wealth, your Bitcoin.
That's the one of the issues with cryptocurrencies is that they largely exist online. They're virtual assets. You see those Bitcoin coins, those gold-colored things with the Bitcoin logo on the front online and in articles and things like that. Well, those aren't real. Those are just images people made up to kind of illustrate the concept of Bitcoin. But you can't actually go out and buy a $50 size gold-colored coin that is Bitcoin. There's nothing like that. It's just an online asset.
Yeah, it's a logo,
and that makes it. It's just a shiny thing with a logo on it. It's not a real piece of money. So that makes it theoretically vulnerable to government responses in the financial markets, to either Bitcoin getting too powerful or to, people using it in ways that bypass legal tender, or people just, looking at what's going on and the government not wanting them to be able to upload it to the cloud. Any of those things can lead to disruptions in the availability of Bitcoin. And that's an issue. The Bitcoin maximalists and crypto guys in general say that's not an issue. There are ways around it. You don't require the internet for your Bitcoin to have value. And I'll take their word for it, but I don't really understand how to do that technically yet. So I think the normies of the world who are not experts in Bitcoin are kind of put off by the idea of the government just making it illegal or shutting down the internet or doing all the things that governments can and eventually will do if cryptos get too powerful. So we'll have to see. I love the concept of Bitcoin, but I just don't understand the technical side and the use case well enough yet to be able to talk about it the way I talk about gold and silver,
Yes. Also, if governments go to digital currency, will there still be some kind of physical currency to run the black market, which is bigger than the government probably understands? Apparently in Europe, the mob uses Pokemon cards to get around currency exchange rules. There's no rule on how much Pokemon or what kind of Pokemon cards you can ship across borders, whereas they have physical currency limits.
Yeah, well, I kind of think that when we go to CBDCs, central bank digital currencies, and we make other forms of money illegal, that we will have a gigantic black market, and silver eagles and silver maple leaves will be the highest quality money in that market. Because they're, 1 ounce coins made of silver are pretty much just the right denomination. Let's say, silver is the equivalent of $200 an ounce at some point. That's great. That's a really useful denomination. And I could totally see that happening. And that's why people should own a lot of silver coins. As much as you think you need, double it. And it probably won't come close to what you'll use if we end up in a situation where there's a gigantic silver and gold black market out there. And that's how we buy stuff from the farmer's market or buy used cars from each other and things like that.
The mining stocks aren't rising along with the price of gold. Why are they lagging?
That's a really good question because really with gold near its all-time high, you would think that the mining stocks should be at a minimum near their all-time highs, and maybe they should have shot through their all-time highs right now. And there might not be a single gold or silver miner out there that's anywhere near its all-time high. And I think part of the reason, two reasons. One is that oil has been going up along with gold and silver. And mining is an energy-intensive business. So you combine higher diesel fuel costs with higher labor costs, and the cost of mining is high enough that it offsets the higher sale prices for the gold ounces that they're selling. So it could be nothing more than that it's just, gold is up, but miners have cost issues, and their cash flow is not going to roar like it should with gold near an all-time high. And part of it could be that it's been quite a while since the miners really rocked. And I think a lot of people have just left the market. So it's going to take a few headlines to entice those people back in or to entice new people back into the market. So the time will come. Like if gold stays strong and the miners continue to lag, there will come a time when the miners wake up and just take off. And then they go back to the price they should be with gold wherever it is. So we could see a nice parabolic move in the miners at some point here because they've been held back for such a long time. So let either gold go up some more from here or oil drop somewhat from here, either of which are completely possible. And then I think the macro environment for the miners gets a lot more interesting. And then you need a few miners to report record cash flow levels. So let's say mid-year 2024, the miners are reporting their second quarter earnings, and they're surprisingly good. And free cash flow just looks really nice and juicy, and they're paying off debt, and they're raising their dividends, they're buying back stock and things like that. And all of a sudden, you get an extremely attractive sector that's beaten down but has really good fundamentals. And that's going to be an easy story to tell. And I think we'll see a lot of money, generalist money, flow into precious metals miners at that point. So it's coming. Just not here yet, damn it.
The yen's touching a long-term low while Japanese interest rates are way up from the cycle lows. Is the Bank of Japan in a no-win situation?
Yes, it is. You know how everybody in the gold space has been talking about how eventually governments would paint themselves into a corner, or they'd find themselves in a box they can't get out of, or whatever metaphor you want to use. That's happened to Japan, where right now the yen is falling. It's right at 150 yen to the dollar, which is a recent record. I think you got to go back to the 1990s before it was that weak. But at the same time, so you would normally counter a weak currency with rising interest rates, right? But at the same time, interest rates are already rising, and that is threatening to bankrupt the government, because rising interest rates are really debilitating for an over-leveraged system because it makes everybody's interest costs go up. So if you raise interest rates more to protect the yen, you bankrupt everybody from the federal government all the way down to homeowners. But if you cut interest rates to keep borrowers from going bankrupt, then you weaken the currency further, and the currency is already really weak. So whatever you do, you cause a different crisis. You fix one crisis, you cause the other. You fix the other, you cause the first crisis. And that's where Japan is right now. And it's not clear if there's any way out. So no matter what they do, they're going to break something, and they kind of just have to decide what to break. And neither one of those things is necessarily survivable. If the yen collapses, then the federal government's ability to borrow incredible amounts of money in order to prop up all the zombie companies in Japan goes away. If interest rates spike, everybody goes bankrupt, and then government revenue goes down, and they go bankrupt too. So whatever they do, mass bankruptcies, a weak currency, et cetera, are out there in Japan's future, and there doesn't look like there's any way out of it. And that means it's a glimpse of the future for the rest of the developed world, because we're all headed that same way. It's just Japan might have gotten there first.
Is that an aging population, not enough of a workforce? The Japanese were the ones who started the drive to using robots to build cars and so on, because they had labor shortages back in the 60s. And is that where we're headed now with AI? The idea is we have a retiring workforce, so we have to have robots come in and do their jobs?
What's interesting, I'm working on a Substack post right now on this exact subject, because there's an interesting debate going on in the world of demographics. Populations have plateaued and are starting to go down because birth rates are falling dramatically. And a lot of countries are seeing their populations shrink pretty dramatically. And so there are two ways of looking at this. One is that's great, because there are too many people now for the Earth's carrying capacity, and the fewer humans there are, 100 years from now, the fewer animal species will go extinct, and the fewer aquifers will be drained dry, et cetera, and we'll all be richer in terms of natural resources on a per capita basis, because there will be whatever natural resources there are divided among fewer people. So that's the optimistic side of population decline. The pessimistic is kind of what you were saying, is that we got these massive retired populations now that are growing dramatically. But the workforce is, in some cases, shrinking, and in other cases, growing much more slowly than the number of retirees. And so at some point, there's going to be too few people to take care of all the old people. And they're either everybody's going to go bankrupt trying to do it with borrowed money, or they will cut the benefits. In the U.S., it would be Medicare and Social Security that retirees get. And a whole generation will just die in poverty of curable diseases, so it would be a mess. Now, the solution to that, there's a possible solution that kind of cuts right through the middle of this, is what you said, automation. So if we're going to have a shrinking workforce at the same time that a lot of jobs are going to be automated, it's possible that those two trends stay in balance going forward. And we end up with way fewer workers, but way more robots. And our productive capacity stays high enough to take care of all the retirees. Now, you got to figure out how to, a lot of people are left behind if robots become a really huge part of the workforce. So we might have to go to something like a universal basic income, where we tax the owners of the robots to pay for the people who don't. That'll be a public policy debate. But if it happens in the context of us being kind of in balance in terms of workers and retirees and robots, then that'll be a manageable process. Otherwise, if we get either of the two other scenarios where we collapse because retirees outnumber workers, or the population stays high enough to destroy all the world's ecosystems, then that's really bad. So let's hope for that middle road that keeps us more or less in balance going forward.
Do you think that we're on the verge of World War III?
Boy, it sure does look like it, doesn't it? In the U.S., and I'll just speak for my country here, we're run by what they call neocons, neoconservatives, who are people who believe that the United States is kind of like the master race, all right? I might not want to, maybe that's too loaded of a term to use in this case, but they're people who believe that 5% of the population in the U.S. should rule the world for the next 1,000 years. And they're willing to basically bomb anybody who gets in their way back to the Stone Age, to overthrow any government, to assassinate any politician here in the U.S. or abroad, to achieve that goal. And they've been kind of turned loose lately, and we're seeing what it's like for those guys to be absolutely in charge of American foreign policy. There is nobody telling them stop. So they're just out there, like we talked about, we're bombing Syria again now. We're funding the Israeli-Palestinian war, funding one side of the Israeli-Palestinian war. And what looked like a kind of a viable peace process in the Middle East is totally derailed. Meanwhile, we've got China surrounded with military bases, and we're looking for ways to pick a fight with them because our neocons think we can beat them right now. We're still, the guys in charge, minus Congress. Congress is the only entity that's not on board for this yet. The U.S. government is basically trying to ramp up funding for Ukraine to try to drain Russia dry of any kind of resources and wealth. One stupid mistake by a fighter pilot or a battleship commander or whatever, and it starts. So I'm absolutely terrified by what's happening geopolitically. A financial crisis is common. They happen every decade. You can live through that. You can make a lot of money from it. But a nuclear war, whole different story. All bets are off, and it's completely possible that human civilization is on the line here. So keep pray that it doesn't happen. And if we get through the next few months and everybody pulls back a little bit, then we dodged a serious bullet.
Well, China's behavior, they're ramming fishing boats that belong to the Philippines. Their fighter planes are putting patrol aircraft from Canada and the U.S. in their wakes as they dive in and out around the aircraft, captured by so-called independent news media even. Chinese warships charging at U.S. warships, making them, or forcing them to make emergency maneuvers to keep from colliding. Is China deliberately trying to poke the U.S. tagger?
Well, two things about that. One is, to say that the U.S. is behaving badly is not to say that the countries we're fighting with are, run by nice guys or anything. They're dictatorships. There would be dictatorships in their neighborhood, not just in their countries. And so they're not good people either. But the second thing about that is, where all the stuff is happening that you just mentioned, it's right off China's coast, or Ukraine is right on Russia's border. It's not on the U.S. borders. We are out there on their borders, and it takes two to tango. You can't have fighter planes buzzing each other unless somebody sent fighter planes from far away to that theater. And you can't have a gigantic proxy war on Russia's border unless somebody from far away funds it, because there's no stomach for that kind of fight unless they've got advanced weapons. And so, the question is, do we want to be involved in every fight everywhere in the world? And do we want to go bankrupt in order to be involved in those fights? Or do we want to focus on defending the U.S.? I would say, make our borders impregnable. And then let Germany and France handle Russia. By the way, France has a bigger economy than Russia does. So combine Germany and Russia, and they dwarf Germany and France, and they dwarf Russia's GDP. So the idea of Russia invading Europe is ludicrous. How would they do that with an economy that's 1/3 the size of the two biggest countries that they would be invading? China is in demographic collapse. Basically, they're demographers out there who are saying that China as a functioning society is over in another 50 years, just because their population is going to start decreasing at an accelerating rate, like we talked about to begin with. They're a victim of plunging birth rates, which means that's not the profile of a society that wants to take over half the world or all of the world or anything. Because normally it's like, well, we need more living space for all our people. Let's go take over Poland or something like that. Well, China doesn't really have any demographic need to do that. So, and they've got Japan and South Korea right there on the borders, who are technologically advanced countries with modern militaries. So it's not even clear that China could, if they wanted to, take over everybody in their neighborhood. So, I don't know. My take on this is that I don't want my kids to be incinerated in a global thermonuclear holocaust. And I think the other rich countries of the world should handle their neighborhoods. Japan and Korea in Europe or in Asia, and France and Germany in Europe, and I think they can totally handle it if we just stop babying them and tell them to handle their own neighborhood. I think they can totally do it.
Well, there was the movie using marionettes, Team USA, World Police. Maybe it's time for to give up that job.
Yeah, that wasn't fiction. That was a documentary.
John, where can people follow you?
I'm at Rubino.Substack.com, and there I'm mostly focusing on actionable stuff. In other words, we know there's a crisis coming. What do we do about it?
Excellent. John, thank you so much for being on This Week in Money.
Thanks, Jim. See ya.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble. He started the website dollarcollapse.com. Find him on Substack at Rubino.Substack.com. Coming up, Wolf Richter, next on This Week in Money.
RecycLiCo, making lithium-ion last forever. RecycLiCo's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. RecycLiCo Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMY.ZF, and Frankfurt ID4. For more information, visit RecycLiCo.com or phone us at 778-574-4444. RecycLiCo, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Wolf Richter, publisher of wolfstreet.com. He's speaking to us from San Francisco. Wolf, welcome back to This Week in Money.
Thanks for having me back, Jim.
Wolf, how high could long-term U.S. Treasury yields go?
So short-term Treasury yields are right now at around 5.5%, so this is up to a year. And as you go up the curve and get into longer ones, a little lower. And the 10-year yield just barely touched 5% the other day and fell off a little bit from that. The 20 and 30-year yields are above that. So that's where we are right now is around 5.5% across the entire yield curve. And the question now is, one, will the Fed hike further? So that would impact the short-term rates. And then what will long-term rates do? And that's more influenced by the massive issuance of new debt that the government needs to sell in order to fund its gigantic government deficits. And it's also determined in part by the Fed's quantitative tightening, because it is no longer buying these long-term securities. It's now letting them run off its balance sheet. And there are other factors in it too, like foreign buyers have been adding to the holdings, but at a much slower rate than the government has been issuing. So now it boils down to American institutions and investors and individuals buying those securities to keep the yields down, and they haven't really been doing that. So now we've got these 5% long-term yields, and I can see where the pressures that we now have are fairly structural. So the upward pressures on yields are fairly structural. The Fed determines the short-term yield, so the up to 1 year, that's pretty much bracketed by the Fed's policy rates. And if the Fed hikes one more time, we'll have close to 6% short-term yield, so it'd be 5.75% in that range. And it'll kind of stay there until the Fed makes another move in one way or another. The long-term yields are on the move, so they have come up a lot. They've come up a lot this year, and they're under pressure from these. We have a $2 trillion deficit this year, federal government deficit, and what turns out to be a hot economy. This is just completely nuts, this kind of stuff. And bondholders and bond buyers, potential bond buyers, are looking at this, and they're getting a little worried about that huge flood of Treasury securities that is needed to fund these gigantic deficits going forward. The government has already announced what it will do in terms of new issuance for the next few quarters through this year. So it did that during the summer, and so we know kind of what's coming this year. And next year, too, and it's just going to get worse. The Fed is stepping away from the bond market. Like I said, they reduced their holdings by $1 trillion. That's a big chunk. Foreign buyers are not there really to pick up the slack. So who is going to buy this? And so the question that solves this is really yield. So yield solves all demand problems. To get buyers into the market, you have to raise the yield. So this is what happens now. Every time we're a little bit short on buyers, the yield goes up, and then the next layer of buyers comes in, and there's a lot of buyers sitting on the sidelines waiting for longer-term yields to go over 5%, over 5.5%, over 6%, and each bigger increase in long-term yields brings in another layer of buyers, and that includes buyers like me. I'm just a small-scale buyer, but some of those yields are starting to be pretty juicy, and so I'm on the sidelines for long-term Treasury securities, and I'm looking and I'm thinking at some point I'm going to step in and buy some of them. And where will this end? So the yield curve is now still inverted, meaning short-term yields are higher than long-term yields. It has flattened out somewhat, so it's not as inverted as much as it was, but it's still inverted. So typically, that's an unusual condition. Normally, the yield curve shows that longer-term yields are higher than short-term yields, and when it's inverted, it will revert eventually. It will uninvert, and it reverts to this normal condition. So the question now is, will it uninvert by short-term rates dropping, which has been the case in the past when the Fed cuts rates, or will it uninvert by long-term yields finally rising above short-term yields? And that's the scenario I now see. I don't really see a Fed rate cut. It's not going to happen this year, and it may not happen next year either. Now that they've pushed the rate cut scenario out to late next year, and it keeps getting pushed out. So there may not be a rate cut next year, and if there is one, it's going to be mild. It's going to be maybe one or two cuts. So the chances are that long-term yields will rise on their own above short-term yields, and that will put them in the 5.5 to 6% range, which is normal, which was normal for decades before they started quantitative easing in 2008. So these are not historically abnormal rates at 5.5, 6% for long-term yields. We're just not used to them anymore. But a lot of these interest rate environments are now normalizing. So I can see that as a sort of a normal thing, 5.5 to 6% long-term yields, which means mortgage rates of about 8%. We already got those. So mortgage rates may not go up any much further because of the spread between 10 years and our 10-year yield and our mortgage rates is now very wide, and it probably indicates that the mortgage market sees higher Treasury yields and already prices them in. So when Treasury yields come up, mortgage rates may not change a whole lot more. So that's what I'm looking at, really longer-term Treasury yields above 5.5%, maybe in the 6% range, with mortgage rates in the 8% range where they already are.
Mortgage rates have increased significantly. A number of people are calling for a housing crash, but so far, no crash. What do you think lies ahead for the housing market?
Well, the term crash is something that looks very different in the housing market than it does, say, in cryptos and stocks. Cryptos can go down 80% overnight. You wake up in the morning and your stuff is essentially gone, and we've seen that. And they're going to routinely go down 10 or 20%. And stocks can go down 50%, 60%, but that takes a couple of years usually. We've had in the history of our stock markets, we've had some huge one-day sell-offs, but they were below 30%. So a real estate crash, we've had one in the United States. We've had the housing bust, and in many markets, home prices went down 50% or more, and that's a crash. But it doesn't happen overnight. It is something that happens over a long period of time, and housing data is issued monthly. It takes a long time to make a deal. Between the decision to buy a home and actually closing on the deal, maybe a month or two. So this is a very slow-moving market. It adjusts very slowly, and the housing bust in the United States back in 2005 or 2012 really lasted 4 to 5 years. So this is something that requires patience. You have to look at it month by month, and there will be ups and downs. But then as the months add up, you can see the longer-term movements. And so now we've seen some of those movements. For example, in Toronto, the prices are already down 15% from the peak. Prices are down further in San Francisco from the peak. In other cities, prices are up. So it averages out a little bit on a national basis, but if you go by local markets, we already are seeing some major sell-offs. But again, this takes years to do. It doesn't end in a few months. This is something that we'll be looking at for years to come, and many housing downturns have lasted for a very, very long time. There wasn't really a particular crash. They just didn't go anywhere. It just kind of tapered lower, and so this can take all kinds of scenarios. But we've seen some pretty steep sell-offs already in some particular markets. But again, we're 1 year into it, and that's not enough. We need many years for this housing market to play out.
The U.S. government claims the economy grew 4.9% in the third quarter. Did it really grow that much?
Yeah, so that's everybody partied. Consumer spending jumped by 4.0%. That is a gigantic move. Consumers are making lots of money. They've got the biggest pay raises. Employment is at a record. Employment has increased strongly this year. So there is a lot of money making going on out there. Consumers are already making a lot more interest on their savings, on their Treasury securities, on the money market funds. They have trillions of dollars invested in these income products. They're now generating 5% interest as opposed to near 0% a couple of years ago. And many consumers are spending that money, especially retirees that are now sitting on their cash flow. So there is a huge amount of consumer spending, and that's 70% of the U.S. economy, or 69% in Q3. So that's the biggest driver of it all, is consumer spending right now. Then we have the federal government and government spending in general, but the federal government in particular. We've had spending spike at the government level by 4.6%, which is huge. The federal government is the biggest driver of that, with spending close to 7% increasing, and that's where the deficits come from. The government is out there borrowing money and spending it, and they're spending it in huge amounts. And we've been saying this for months. You can't have a slowdown if government spending is so gigantic. Government spending so this is really investment and consumption by government. It doesn't include the federal government spending on Social Security, welfare, and those kinds of things. They're counted when the recipients are spending that money. But in terms of government spending, that is a gigantic leap. It is just incredible. In a healthy economy, that the government has this kind of borrowed spending binge is just kind of nuts. And then we've had private investment. So this is a lot of inventory, a lot of businesses building stuff, and that increased by 8.4%. So this is construction of residential, non-residential equipment, software, all kinds of things go into this. And this is 18% of GDP, and it jumped by 8.4%. So these are really, really big increases. There's some things in it, that especially our trade deficit got worse. So that detracts from GDP. Our trade deficit is always horrible, and it just got a little worse. And then we had an inventory measurement, and inventories are business investments, so that is where businesses invest a lot of money, so that counts in GDP, and inventories grew, so that added to GDP. So, I mean, outside of the trade deficit, everything pulled in the right direction, led by consumers and government and business spending. It was just one big, gigantic party in Q3. And I wrote about it, and at the beginning of the article, I have my cartoon of Jerome Powell tearing out his hair, which I use for those kinds of things because it's just crazy what's happening. There is absolutely no slowdown in this economy. It has accelerated. I've been writing about it for months. We've seen the data points come out for a month. Consumer spending, government spending, business spending, it's all been going up. And so today we got the quarterly results, and adjusted for inflation up 4.9%. Yeah, consumer spending up 4%, gross private investment up 8.4%, government spending up 4.6%. I mean, these are really, really, really big numbers. And, they will stir up inflation. That's what this does. There is no there is no reason to think that inflation will just vanish on its own with this kind of demand out there.
Are American consumers ready to cut spending?
Everybody's been predicting it, and everybody's been hoping it, and all kinds of models have been dragged out to show that consumers are tapped out or whatever, but consumers are getting the biggest pay increases in decades, and the record number of them are working, and they're getting the biggest interest income streams in decades, and they have the most savings ever and the most money invested ever in money market funds and Treasury securities. So they're making a bunch of money, and they're spending this money. And as long as they're making this money, consumers don't want to slow down. And I call them drunken sailors, but they're really not drunken sailors because they're still saving money. They're spending only part of their increased income, and the rest they're saving. So they're really in pretty good shape. And we've seen that month after month. We've seen it in retail spending. We've seen it in other consumer spending. We've seen it adjusted for inflation and not adjusted for inflation. It's all the way through. Consumers are loving this environment. They bitch about inflation, but they're loving the higher incomes they're getting, and they're spending it. And, yeah, inflation, people hate inflation. But they're spending it. Yeah, they're spending their money. And just because the consumers are in a foul mood about inflation doesn't mean they're not spending. And we just have not seen any indication that consumers are going to slow down. As long as hiring is good, and it's still good, and as long as a record number of people are working and they're making record amounts of money, and the pay increases are now outpacing inflation this year for the first time. Prior 2 years, inflation outpaced the pay increases. Now that's turned around. Now people are making more money than the inflation is eating up, and this all stirs up consumer spending. So I don't see something would have to happen for this consumer spending to slow down. They would have to make less money, and they would have to lose their jobs, and maybe that will happen. That we get some big layoffs, we get some unemployment increases. And we get some pay decreases, but that's not happening now. So until that happens, I see consumers just keep pulling.
Does a reduction in consumer spending usually lead to a recession?
Well, yeah. If it's sustained, consumer spending is around 70%. So in Q3, it was 69% of GDP. So that's the biggest item. Consumers are the number one force in the economy when it's counted as GDP. And so when they slow down, that's 70% of the economy, and so it's felt. If they slow down just a little bit and government spending is strong and business spending is strong, it might not lead to a recession, but if they slow down a lot, generally we get a recession, meaning slow down, meaning decline. You need to have a decline in consumer spending, so less than they spent in the prior quarter, and then the following quarter less than they spent in the prior 2 quarters. So it needs to be an actual decline, not a slowing growth. And we have not seen any kind of decline in consumer spending since the lockdown quarters in 2020. Growth sometimes speeds up, and growth sometimes slows down, but it's still growth, and so you can't really have a recession with these different elements growing. For consumer spending to actually decline in a sustained manner, you need some external events. They need to lose their jobs, and that's a primary thing. And fewer people need to get hired, and pay increases need to come down. So you need to see that, and we haven't seen that. So I don't think there's any chance right now that we'll see that. But if we do see that, and if it's sustained big enough, it will cause a recession, and it can cause a very big recession. When consumers shut their wallet, it will make the global economy shake in its boots.
What's happening in the new and used auto markets, and is it a good or bad time to buy a vehicle?
Well, let me take the second part of that question first. It is a bad time to buy a vehicle. Vehicles are overpriced. Used vehicle prices are not coming down, and they have been coming down, but they're still extremely high. We just became a forced buyer of a vehicle after our vehicle got totaled in an accident. And so we went through that, and it's just stunning. The amount of money we got paid for our vehicle from the insurance company was stunning. It was a huge amount. It was more than we'd paid for it, several $1,000s more than we paid for it when it was used a few years ago. And then we went out to buy another vehicle. The price was even more stunning. So it is a really bad time to buy a used car, and used car sales have tapered off a little bit. Prices are just very high. Interest rates are high. It just, if you can wait, just wait. Prices have come down quite a bit in used cars, but they've spiked by 60%. So now they're down 10 or 12% from the peak, but they're still very, very high. So there's a good chance if you wait a few more months or a year, the prices will come down further, and it will make a little bit more sense maybe to buy. New vehicle prices have not come down, and new vehicle sales are up 20% year over year, and in part because the gap between new and used vehicle in terms of pricing isn't that big anymore, because used vehicles have spiked so much in pricing. So people add a little bit extra and they get a new vehicle, and so new vehicle sales had collapsed when they ran out of inventory in 2021 and 2022. So off of those collapsed levels, they're now surging. They're still far below where they were during the records we've had in 2016, 17, and in 2000, roughly 2000. You got to remember, new vehicle sales in terms of numbers of vehicles at the peak haven't really changed in 20 years. What it is a stagnation interrupted by huge plunges in volume. And during the financial crisis, volume plunged. So before then, we sold 17 million units a year. Then during the financial crisis, that plunged, and then gradually it recovered. And then in 2016, 17, 18, 19, we were back to 17 million units per year. And then we plunged again, and so now we're at 15, 16 million units, gradually working our way back up to that 17 million range, and then something else happens and sales will plunge again. So that's the scenario we've been looking at for over 20 years, that there really isn't any growth in vehicle sales. There's a growth in dollar sales because they're getting more expensive, but not in vehicle sales. So now vehicle sales are up 20% from these low levels of 2022. And so that's good in terms of where we are, in terms of GDP and in terms of the economy. But compared to where we were, it's still not very good. And that's kind of the market right now. Now we've got strikes going on. So the three big Detroit automakers are going to see the production impacted by those strikes. They still have lots of inventory. So right now there's inventory to sell, but if the strikes last for a long time, that could impact inventory. So there'll be shortages on those vehicles, and that could push up prices and push down volume. On the other hand, Tesla and the import models are not impacted by those strikes, so they can fill in, and they're rocking and rolling, and Tesla especially. So It just, any decline in volume due to the strikes will be at the expense of the Detroit automakers and will be for the benefit of the other automakers.
Are electric vehicles continuing to gain market share?
Yes, they are, in leaps and bounds. And what's happening is the whole scenario has changed now. Tesla has cut prices by mega amounts in a completely unprecedented manner, and it's still making money. It just reported third-quarter profits, and it still made $2 billion. And its gross profit margins have come down, but they're still positive. They're still pretty good. So those price cuts are sustainable, and they've changed the equation for the other automakers. So the legacy automakers, they were thinking that EVs are going to be expensive, high-profit vehicles, and they were pricing them as such. And then Tesla comes in and says, no, we're not doing that. We're cutting our prices by a whole bunch. And suddenly Ford and GM are discovering that they cannot build vehicles, EVs, at these price levels. And so they're not scaling back. They're needing to re-engineer the vehicles and the manufacturing to be able to profitably build EVs that can compete with prices that Tesla puts on the table. And so now they have stepped back from EVs to try to rethink this and to re-engineer production and re-engineer their models a little bit to make them cheaper to produce so that they can compete with Tesla. And that was just completely unplanned for. And Tesla is just screwing them up. And I'm loving this because I've worked in the industry. I've seen how automakers rip off consumers. There are 4 pickup truck makers that make full-size pickup trucks. There are 4 of them. And they have exhibited oligopolistic behavior, and pickup trucks have become incredibly expensive. It's just a scandal what happened. And so now we've got the EV makers with the pickup trucks, and Tesla threatens to completely blow that up. So they have offered price points now, and they've thrown them out. They're obviously not yet making the Cybertruck, but they've thrown out price points that will pull the rug out from under those 4 ICE pickup truck makers. And so this is what we're seeing, the dynamics. Now, the EVs are coming in, and they're mucking up the pricing of the legacy automakers. And they're now scrambling, trying to figure out how to deal with this. And I'm loving this because I'm finally seeing some new vehicle price pressures from competition. If you get any of these Chinese automakers come in with their EVs, and there's some movements there, they're going to be lower priced too. So I hope that consumers will finally benefit from this new competition that we see in the EV market. And that has been incredibly successful in gaining market share is these price cuts, because now suddenly you can buy a very good EV for a very affordable price. And very affordable, meaning that all new vehicles are essentially unaffordable for very many Americans. The average transaction price for a new vehicle is $47,000 now. And so Tesla is selling its lower-end Model 3s well below that. So that's where we are. That's why EVs will continue in part, while they will continue to gain market share in leaps and bounds, because they're now becoming very price competitive, and they're pushing prices down instead of up. And Ford and GM are completely unprepared for this.
China, for example, has a Volkswagen-made EV called the Viking that's only $10,000. Sounds like a nice little urban runabout that, for a lot of people, would be perfect.
Yeah, so in the United States, maybe these kinds of vehicles are tough to sell for a couple of reasons. One, they have to conform to the U.S. safety requirements, and that may be tough on a little vehicle. And 2, Americans really don't like tiny vehicles and small vehicles. There have been some. They've never been successful. We've tried to sell them back in the day, and people rather buy a 3-year-old used car than a new tiny vehicle. So those are just very tough to sell. But I think in the $20,000 range, you will be able to get a very good EV, a 4-door sedan, or a compact SUV. And that's the future, I think, is the $20,000 price point, and it will have all the electronic bells and whistles. It won't blow from 0 to 60 in 2.9 seconds, but it'll perform better than ICE vehicles in that size, and it'll be a lot cheaper. You can't really buy anything below $20,000 in the United States. So that's and what you buy in that range, it's very limited. So if you can come up with a good EV that people like in the $20,000 range, and Tesla is shooting for that, and other automakers are now shooting for that. The Bolt was already pretty close to that with its basic vehicle that's going to discontinued. So this is really the price point where Americans can afford the vehicle and they would buy it because it's an adequate vehicle for what they want. And Americans, we are a car country. A car and truck country, I have to say. We like vehicles. They're important to us. So we want to buy something that fits not only our needs, but our image and what we like. So manufacturers have to offer that, and I think there will probably be EVs in that range that are suitable for that, where Americans think, yeah, I want to own that. I want to be seen in that vehicle, and that will completely trip up the Detroit automakers. It will completely trip them up. They're not at all prepared for this. They thought EVs are going to be $60,000, $70,000, $80,000 vehicles, and they're going to make $20,000 in profit of each of them, like they do on the pickups. On the pickups, they make more than that, and that game is now over. Tesla has shown that. Tesla is saying, look, this is price competition. You need to bring the cost down, and the Chinese automakers are doing the same thing. They need to bring the cost down. It's a brutal battle over there, and I can see that coming to the United States.
The province of British Columbia says in 2035 it's going to ban the sale of non-electric vehicles for light-duty use and passenger use. Is it possible for governments to do that? And what happens for people who still want to buy a gasoline-powered car? Will there be a black market?
Well, I don't think there'll be a black market because you have to register the vehicle. I mean, you could, in theory, register the vehicle outside of British Columbia, and in California we're facing the same situation. Yeah, so you could register outside of the state, but you get caught driving a vehicle that's registered in a different state and you live in California, that has consequences. So that's not going to be easy to do. On the other hand, you can buy a used vehicle, and you can bring a used vehicle in, and you can buy a used vehicle. You can buy a new vehicle right before the ban goes into effect, and you can continue to drive the new vehicle for 30 years if you want. So it doesn't eliminate ICE vehicles from the streets, and it doesn't prevent you from buying ICE vehicles. You can buy used ICE vehicles for decades to come. It will just prevent you from buying a new ICE vehicle in that province or in that state. And so after the ban goes into effect, and so that the impact isn't going to be that huge anyway. It's just buyers. It's not that it doesn't impact the existing fleet at first. In the United States, we have 270 million vehicles in the fleet, and almost all of them are ICE vehicles. They're going to stick around, and as they get older and as they get totaled and so forth, they will start shrinking, and gradually the EVs will become a larger part of the national fleet. But the national fleet isn't going to change very quickly just because of a ban on ICE vehicle on new ICE vehicle sales. So this is a very slow process. And can governments do that? Well, that's not for me to answer. Apparently they can because they're doing it. And so maybe they'll be challenged in court. Maybe they will be turned over in court. But so far, those bans have held, and it doesn't really, in the way I see it, it doesn't really impact much, except that there are a relatively small number of buyers who would want to buy a new ICE vehicle every year after that ban, and they can buy a used one, but they can't buy a new one.
What happened with all the layoffs by the social media and high-tech companies?
Yeah, that was kind of fun to watch. It started in early 2022 when we got some of the first layoff announcements, and then it became a tsunami of layoff announcements, and all the big tech companies announced them 10,000, 20,000, 30,000 global layoff announcements. And then when I started looking at it, in terms of our actual layoffs as they're being reported, that there wasn't all that much. Number one, those announcements were global layoffs, so they're in all countries, and so not impacting our local economies. And then number two, the actual layoffs were a lot smaller. And so I just looked at Google's employment numbers, and they announced 12,000 layoffs in early January this year. In the first quarter, their total headcount actually increased. In the second quarter, their headcount dropped by a little over 8,000 people. And then in the third quarter, they just reported the headcount yesterday, it increased again. So the net reduction in the headcount was only like 7,500 over the three-quarter period after they announced a 12,000 layoffs. And this is kind of happening all over. They're announcing layoffs. They're laying off some people through one door, and they're hiring lots of people through the other door. And so you have a lot of churn. They're laying off the deadwood, and they're laying off some people where they closed the divisions, and they're reshuffling some stuff. And so you're seeing these people being let go, and then a lot of people being hired. And the people that are being let go are being rehired by other companies. So that you have this sort of shift going on, and it's calmed down now. The layoff announcements sort of tapered out in the first half this year, and there haven't been very many. Now they're hiring more carefully. And the effect that this has had is that we didn't see this wave of unemployed tech workers show up on the unemployment rolls. They never did. There's a little bit of an uptick, and then they declined again as they found jobs. So our employment picture, our labor market stayed strong throughout all this, even though you could see some ripples, but it didn't really impact it because it never really happened. There's just this churn going on, and it's over now. And but there was a real effect in terms of the psychology of it all. The workers got scared. They quitting jobs, and we've seen that in the data. And they ask for raises and in more modest terms. The starting salaries don't have to be as huge because, and the recruiting incentives don't have to be as huge because people are more worried now about getting laid off, and so you see the dynamics changing, and the way I've said it is some of this was done to show these workers who the boss is. These companies did this to get control over their employees again. They have lost control during the pandemic. They had this huge demand for wage increases, and people were quitting left and right to find better jobs here, better jobs there, and that created this huge amount of churn. The companies had to rehire people that left, and so we had these spikes in wages. And so the companies decided, no. We're going to reassert our authority here, and we're going to scare people, and we're going to announce these big layoffs. And some of them were real, but then they're hired at the same time, so it didn't really impact employment much. And that worked, and that really worked, and it scared the bejesus out of a lot of workers, and they're back to being more humble about it, and now companies are demanding that workers are coming back to the office, and at least part of the time, and so now they're grumbling about it, but they're going back to the office rather than quitting, and so this is the real effect of it, and I've made that point that it really didn't have much impact on the labor market, but it had a huge impact on the psychology of these workers, and with companies exerting their authority over the labor market. And, this is not necessarily a good thing, but that's how that turned out. Obviously, there are a lot of small companies, startups that are shutting down. They're laying everybody off, and we've had because of the startup money's vanished, and they're not getting funded anymore. So they're being left by the wayside, and so we have in that area we have people that are getting laid off, and they're getting picked up pretty quickly by other companies. So the labor market has been incredibly strong in the United States throughout all this.
Wolf, can you tell us a little bit about Wolf Street and how people can sign up for it?
Wolfstreet.com. It's all free. It's all there. You don't have to to sign up for anything, just come to wolfstreet.com. I've got a great cartoon under my GDP article today of Jerome Powell tearing out his hair right on top, so you've got to go see that. And we have fun in the comments, so well-behaved, good comments, lots of them below each article, wolfstreet.com.
Wolf, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, John Rubino, and Wolf Richter. And thank you for listening. If you have any questions for our guests or the show, you can send them to info@howstreet.com. Now stand by for a company showcase update from Zarko Meseldzija, the CEO of RecycLiCo. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Zarko Meseldzija. He's the Chief Executive Officer of RecycLiCo. Welcome back to the show.
Thanks for having me, Jim.
What's the latest at RecycLiCo?
Well, as some of you may know, I'd like to start off by reminding everyone that our AGM will be held in person on October 31st at our office in Surrey, BC. For those of you who haven't already voted your shares, the cutoff for the proxy is at 11 a.m. Pacific time, this Friday, October 27th. If you're having trouble voting your shares or don't know where to do that, then please call our office at 778-574-4444 or email investorservices@recyclico.com. Please have your name, address, and your broker's name and address and email prepared. Teresa Piorn will be able to help you right away with this and get those shares in. So that's really coming up next week. And also kind of why we wanted to do the podcast a little earlier, so some don't miss that cutoff. In regards to kind of what's the latest in the industry, what's been happening. I think this week there was a lot of news that came out. We got a lot of messages about it, and I want to be also. I also want to be respectful in kind of what is said, but I understand that there's going to be complexities of giving public comments on other battery recyclers, and because after all, all of our goals are to make positive change to the environment and to close the loop on battery materials. However, I think it's also important to highlight the greater impacts on the battery recycling industry and recognize the differences so it doesn't bring about doubt in others. So this week, a battery recycling peer of ours decided to pause construction of their processing facility in North America. And this is a hydrometallurgical plant for converting black mass into intermediate commodities such as nickel sulfate and cobalt sulfate. And the plant was expected to cost, over $500 million US. But with the rising costs, their board decided to pause construction work. This is obviously a major setback because to date they've been operating multiple battery shredding facilities which produce black mass, but their strategy was to have a central facility that refines the black mass. Now, in the past, I know we've attended a lot of the same events early in our development, and we're sometimes the only recyclers in a room at some of these events at that time. But they were also one of the first to demonstrate their standalone battery recycling business model, and since then we have seen the same business model play out with a number of other recyclers around the world. and with hundreds of millions of dollars going into these major projects. However, we don't believe that, a different company name with the same business model will make things easier. And we want to make it very clear that our business model and technology is different. So all recyclers kind of aren't lumped into this same category. As one listener wrote to me, he said, quote, "You have been stating for quite some time that building out a large-scale recycling plant was not a smart option," end quote. And we still believe this, and I want to reiterate how we are different. And first, early on, we recognized a few key points. One was that sourcing a consistent supply of battery materials would be the biggest risk in the industry. Two, the biggest source of battery waste would originate from battery and electric vehicle manufacturers. Three, the knowledge gap in the industry is how to efficiently refine black mass into higher value battery ready materials. And four, battery materials are critical materials. And with an increasing gap between supply and demand, it's important for battery and electric vehicle manufacturers to have control of their own supply chain. Given all this, RecycLiCo has focused on developing a moat around its advanced hydrometallurgical battery recycling process, which is focused on upcycling black mass into battery-grade precursor cathode material and lithium chemicals. Now, these products have also been tested in new battery cells, demonstrating the fully closed loop. Therefore, our process can enables us to modularly scale a CapEx-light JV model with multiple strategic partners who aim to vertically integrate their battery supply chain. So what I mean by this is by adopting our technology in-house with strategics such as battery manufacturers and EV manufacturers, we can solve the knowledge gap on technology, and we can also have the material completely circular within one battery plant and have that whole ecosystem from manufacturing to recycling all in kind of one general area. And I think I've always said it, just as like a final comment, technology is not developed and scaled overnight, and what may be perceived as slow progress can turn out to be better than taking multiple steps forward and then one major leap backwards. So I know a lot of questions were coming in on this, so I thought I would address it along with the upcoming AGM. And any questions, I know I get a lot of questions sometimes from other listeners as well. Please understand that I can't answer all of those out of confidentiality of some material. If there's something that I can announce publicly or share, we'll share publicly. But some of these questions that do come in cannot be answered or have also been answered before in the past through our podcast and various press releases. So that's all I have today, Jim.
Zarko, for people new to RecycLiCo, can you tell us about the company?
RecycLiCo is a battery materials company focused on recycling and upcycling waste lithium-ion battery materials and producing battery-ready products that can be directly integrated back into new lithium-ion battery manufacturing, and essentially enabling a closed-loop circular economy. And for those of you who want to know more, you could visit us at our website, www.RecycLiCo.com. We also are traded on the TSX-V under the ticker symbol AMY, on the OTCQB under AMY.V, and the Frankfurt Stock Exchange under ID4.
Zarko, thank you so much for the update.
Thank you.
My guest has been Zarko Meseldzija. He's the Chief Executive Officer of RecycLiCo. I'm Jim Goddard. Our conversation took place on October 25th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of House Street Media Incorporated.